Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock. With news, equity markets are falling in a sharp case of risk aversion due to rising interest rates. Overnight, New York Fed President John Williams said he expects the Federal Reserve to return its target interest rate to normal or neutral levels within the next year or so. He said that once rates were at a normal level, then the Fed would be well positioned to respond to surprises, either inflationary or a softening in the economy that may require raising or lowering rates. He didn't suggest what the normal rate range is, however. While the Fed may not be stimulating the American economy artificially, Congress certainly is, and at a faster rate. US federal deficit for the full year since September has come in at an enormous $900 billion, 35% higher than the $665 billion in the previous budget year. The political will to control these exploding deficits has evaporated. For perspective, the US federal deficit has risen from 3.4% of GDP in the year to September 2017 to 4.3% in the year to September 2018. This debt binge is unprecedented, accentuated by large corporate tax cuts. At the current rate of deficit spending, it'll be 5.5% of GDP in 12 months and rising. Almost certainly, it has passed the sustainable rate of interest payments that are now taking a bigger slice of their spending than even what is spent on defence. And of course, rising interest rates just expose the issue of a bigger, earlier shock. Confidence could leak away quickly when markets take fright. In the giant US home loan market, rates for a standard 30-year home loan topped 5% last week and a new 7-year high. More, the rate jumped 9 basis points in a week, but demand was down with new applications falling. In China, they're about to expand the list of too big to fail companies and financial institutions. That will require them to raise much larger capital buffers and comes as concerns mount about the resilience of those institutions in their economy. Yesterday, the Shanghai Stock Exchange eked out a small rise that is in stark contrast to what is happening on Wall Street this morning, where investors are fleeing risk, and the S&P 500 has tumbled 1.9%, the Nasdaq more than 2%. Earlier European markets all dropped about 2% as well. In its latest Global Financial Stability Report issued overnight, the IMF has fingered Australia for risks to their economy from bulging household debt and high house prices. But New Zealand doesn't get any mention of that concern. When New Zealand does get mentioned, it is about our low government debt levels compared to most other countries. US Treasury 10-year yield is high today at 3.23%. Their 210 curve is now at 33 basis points. Gold is at $1,189 an ounce this morning, another small $2 rise overnight. And US oil prices are down by about $2 today at just over $73 a barrel. The Brent benchmark is now just over $83 a barrel. And the Kiwi dollar is starting today at 64.9 US cents, having firmed it a little in the past 24 hours. Oddly, we aren't yet a victim of that risk aversion this time around, so far at least. It's the greenback that has fallen. On the cross rates, we're now at 91.2 Aussie cents and 56.1 euro cents. That leaves the TWI at 68.8 and unchanged from this time yesterday. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.